All right, well, we still may have a few folks come on, but I think we're going to go ahead and get started this morning. So welcome. Good morning again. Thanks for joining us on this webinar today, talking about giving through IRAs. The IRAs, the RMDs, the QCDs, a lot of alphabet soup there, right? My name is Tyler Curtis. I serve as the Chief Development Officer for the Kansas Methodist Foundation. And we are all about helping people of faith be good stewards. We want them to take those resources that have been given to us, have been entrusted to us, ultimately by God, and help people grow in their generosity. If there's something that we can do to support, to serve you, to serve your church, to serve your neighbors, please let us know. We certainly thank you for being here. Before we get started, a couple little housekeeping items. Again, this presentation, if you're new on there, we are recording this, so we ask that you keep your mic on mute to avoid that background noise. We also invite you to ask questions, so please submit those through the chat box. If you're familiar with how to do that, it's at the bottom of the screen. Just open up that chat and you can ask everybody, or you can target that towards myself, and that's fine too. We'll get those questions answered, and we'll certainly have a Q&A portion at the end as well. So with that in mind, let us just be in an attitude of prayer as we get started today. God, we just thank you. We thank you for this day. We thank you for this opportunity to come together as your people. We ask you that to be here with us, for your presence to dwell among us. Just be with our hearts, be with our minds, as we think about all the resources that you have so richly blessed us with. You are the owner, and we are the stewards. Help us to have that stewardship mentality. The caretakers of many gifts. How do we use all the gifts that you've given us, whether it's our time, talent, and certainly our treasure, to do what you want us to do, to make disciples of Jesus Christ for the transformation of the world. And God, we just ask all of this in your Son's most holy and precious name. Amen. Presenting today is our staff member, our president and CEO, Dustin Petz, Reverend Dr. Dustin Petz, by the way, who certainly has served as a clergy person prior to being in this role. He served as a local pastor for 18 years, started in this role back in 2018. He's a graduate of Kansas State University, has a bachelor in agribusiness, and then received his MDiv from St. Paul School of Theology, many of you are familiar with, as well as a master's of theology at Princeton, and ended up getting his doctor in ministry from Wesley Theological Seminary. Starting in 2014, he served on the General Council of Finance and Administration for the United Methodist Church. Is currently the chair of the Fiduciary Foundation and Property Matters Committee, as well as the investment committee. So Dustin has a lot of experience in investment management as well as in giving techniques, and he is going to present for you today. So Dustin, I'm going to turn the digital floor over to you.
Awesome. Thank you, Tyler. Welcome, everybody. It's a great joy to have you here together for this presentation. It's kind of brought about by lots of people asking us questions and wrestling with how can we make the most with our resources to impact our church. And one of the great tools is using our IRAs to make charitable gifts to support the ministry and work of the church. And so I'm grateful that you're here. As Tyler said, just share your questions into the chat, and he'll interject those questions, and we'll do our work along the way. Before we get into the technical pieces about giving through an IRA, I just want to point out the focus of our work is really about how do we raise resources for doing ministry? How do we have ministry dollars to impact the church and the different areas of the church, or even other charitable causes that are important to you? I guess I don't want us to focus on the technical piece and miss that it's really about our heart. It's about us being good stewards of our resources. It's about using the resources that we have been entrusted to make a difference in ministry. God has indeed provided us with every blessing in abundance so that we might have enough of everything to share abundantly and joyfully in good work, to make disciples, to heal the broken places in our world, to reflect the hands and feet and love of Jesus Christ so that our world might look more like the reign of God. So I want to point that out. I also just want to highlight, maybe you heard this in the prayer that Tyler offered, but the theology that we come to related to resources is that the resources in our lives are God's. That God is the owner of the things. My name might be on the account or the deed, but it is God's. I'm rather a steward. I'm a caretaker. I'm a caretaker for a period of time, and then someone else is going to be a caretaker. And so having our understanding of being in that position, and then maybe you're asking, God, what would you have me to do for me to be a faithful steward of the resources that you have entrusted to me? And then this last bullet of how do we take positive action to make a difference, to be a blessing as we have been blessed. John Wesley said, earn all you can, save all you can, give all you can. And I think he was pretty concerned that we as people and within the Wesleyan movement, Methodists more broadly, we might do the first two and fall short of doing the third. That was a concern for him. So that's in a big part why we do the work and ministry that we have, is to help you to be good stewards and to be generous with what you have been entrusted. As you think about your resources, my encouragement is to wrestle with, pray about, try to discern, search the scriptures, and try to ask God, what would you have me to do with what I have been entrusted? And maybe to ask this question, God, what are you calling me to give to the church, or to, maybe it's even more broadly, to other 501c3 charitable causes, and to come to discover, what is that amount? Maybe it's a tithe, or maybe it's another percentage with the hope of moving over time to grow that. And to see how we might grow in our relationship with God through good stewardship of the resources in our lives. Once we gain kind of that, then we can think about how can we fulfill that charitable gift in the way that makes the most impact, the way that has the least tax consequence, or is able to make a bigger difference with those gifts, which is where the traditional IRA and giving through our IRA comes into play. And so that's what we're going to move to. Before we move to more of the technical things, I want to clarify, I'm not an estate attorney or a tax attorney. I'm not a CPA. And so this is for information, and invite you to contact your professionals. This is not advice, but contact your professionals to help you with your particular circumstances, or over time as things might change with different rules. So for many of us, not everyone, but for many of us, we often have these tools that are qualified retirement plan assets. We have tools that are accounts that we can set up called traditional IRAs, or even if you have an employer or used to have an employer, many of them provide a retirement kind of account. And these are scenarios where we put money into those accounts prior to paying tax. So they're pre-tax contributions. You seed it, if you will, with pre-tax dollars. And then they grow over time, and you don't pay the tax on those accounts over time. It's only when you pull the money out, at harvest time, if you will, when you will have a tax incurred upon you. That's the case for all these different types of accounts. There are some circumstances where you can pull out money early, but in general, most of them are built so that you start withdrawing without penalty once you become 59 and a half years of age. So they're means for us to to invest dollars along the way so that we have resources at the end of our later in our lives when we no longer are working. And it's important to understand that all of them will have at some point in time a required minimum distribution, an RMD. This is simply the amount that you have to take out once you get to an age at which time we're instructed by the IRS that we have to start taking money out. And when the money does come out, when you, if you will, pull the harvest time, you didn't pay tax on the front side, but you do pay tax when you pull money for your living, when you start taking those distributions. As I said, you can start taking distributions at 59 and a half. There comes an age when you're required to take the distributions. And when you start pulling those out as an income source, you have to pay ordinary income tax. There's some nuance related to clergy and housing allowance for some situations, but in most of the situations, for many of us, you'll have to pay ordinary income tax at your tax bracket at the time you file and take those receipts. So let's talk about RMD. For a long time, the required minimum distribution, that is this dollar amount here, the minimum amount of money that must be distributed out of your IRA to avoid a penalty. That amount of money, we'll talk a little bit more about that. At a certain age, you start having to have a set dollar amount you have to start pulling out. It used to be that it was 70 and a half years of age, and that's how it was for all of us. They ended up raising that age at which time you have to take out this required amount to 72 when the Secure Act came about. More recently, the Secure Act 2.0 came about, and it raised the rate even further. If you had not already started receiving an RMD, your age changed, and they put in place for folk who are born after it's from 1960 and beyond. The mandatory age rate will be 75. So that's where I fit. I'm 47, and so right now, given the current rules, I will have to start taking a distribution at age 75, or I'll have a required minimum distribution to be pulled. So I want to clarify that those things have changed over that period of time, and it should be the administrator of your account should help clarify if you have this certain amount that you have to start taking at a particular age. And if not, then you can take resources if you're 59 and a half, but you're not required to take that certain amount. So RMDs, this amount is a calculation. Your fund administrator probably does this for you, whoever that custodian is. And my suspicion is they tell you pretty early in the year, welcome to the age of RMDs. If you're at that place, that's why they would tell you this. Your calculated amount is X, whatever that dollar amount is. And this is how that's calculated. Most situations, you're not going to need to calculate it. They will calculate it for you and tell you, but this is how they're coming up with these numbers. So it is taking simply the fund balance at the end of the year and dividing it by this life expectancy factor. This graph here quantifies what some of those numbers are. I didn't put all the numbers. You can see what the numbers are. You can go online. You can type in life expectancy factor or uniform lifetime table from the IRS and get these factors. So it actually goes down to 120 years of age and beyond. And so you can look at that. But I made an example here. So let's pretend a person's account at the end of last year, 12/31, was $400,000. Based on your age, you have this kind of factor. So if in the event that you are 78 this year, this dollar amount will be divided by the life expectancy factor of 22.0, and it will mean that you will have to pull out of your account without penalty. If you don't want a penalty, you'll have to pull out $18,182. And so your custodian should likely say, Dustin, your new required minimum distribution for this year is $18,182. And then I have to pull that amount out throughout the course of the year so as to avoid a penalty. And this kind of, I've been saying these things, but I just want to highlight a little bit further. If I'm younger than 59 and a half, there are some scenarios where you can get the money out. In many of the situations, there's a penalty, but not always. I'm not going to go into all the details about that, but if that is a need, I think there's some hardship cases where you can do that. You can look into that, but there is no requirement to pull out money prior to 59 and a half, and you cannot do what we're moving into now is a qualified charitable distribution. Once you maybe retire and you're 65 and you're receiving resources from Social Security possibly or some other pension plan, you can start pulling money out of your IRA. You don't have a requirement to pull it out, and you are unable to do a qualified charitable distribution. But when you do turn 70 and a half, you can start make a qualified charitable distribution. I have some folk who've conveyed to us, I just turned 73 and now I have to take an RMD, which is the case here, and now I can do a qualified charitable distribution. Well, that's actually incorrect. The age at which you can do a qualified charitable distribution did not get increased like the RMD age. So once people become 70 and a half, given the current rules, you can make a qualified charitable distribution from your account, your IRA. You may not have an RMD yet, depending on your situation. You may not have an RMD yet, but you can do a qualified charitable distribution. Right now, if anyone is 73 or older, and you have an IRA, you do have to do an RMD, and you have the option to make distributions to your church or other charitable causes that you would have. So you need a traditional IRA, and you must be 70 and a half years of age to do that. Earlier, I spoke about people having a 401k or a 403b. You're not able to do a qualified charitable distribution from one of those instruments. But you, in some situations, are able to roll over. We'll get to that in a bit. You're able to roll over into a traditional IRA. The QCDs will come from the traditional IRA to make a difference. So let's just use an example. I gave that an example above. I ran a simulated calculation for a person who has a $400,000 account and is 78 years of age, and their custodian lets them know at the beginning of the year for 2024, you have an RMD, that is, you have an amount of $18,182 that you have to take out, okay? This is the requirement if you want to avoid a penalty, has to come out of your account. What happens for many of us is that we take it as income, okay? And then we have an income deduction. Your administrator may pull out some tax and send that on behalf of you. It depends on your situation. But you at your tax rate will have to pay tax either when the money comes to you or when you file your taxes in the following year. I'm using just an illustration. This is not the case for you, most likely, but let's pretend you have a 22% tax responsibility. So you in the end, you're not going to get all $18,000. You're going to get closer to $14,000, which is 18, reducing it by this 22% tax. For some of us in our churches who are 70 and a half years of age or older, we take the full amount as income. We pay our tax, which is, as you can see here, $4,000 in our tax, okay? And then we may decide we want to give a gift out of our bank account or a cash gift, or we write a check, or we do a Venmo, we do an EFT, whatever it might be, and we make a gift to our church. and let's pretend the gift is $6,000. So we give that gift as a $6,000 gift. The remainder of this amount that we can use for supporting our living is just over $8,000. That's how many families do this. And I think that's in part because they don't know that there is another option. The alternative option is to direct our account and our administrator to distribute, once we're 70 and a half years of age or older, a portion of our funds straight to the church or straight to another 501c3 charitable cause. And if we do that distribution, that can count towards this required minimum distribution. And as you see here, you can actually give a very large amount. You can give up to $105,000 per person per year, starting this year. Last year was $100,000. They raised it. So in 2024, it's $105,000 per person to different charitable causes. You can pull more than that, but you'll have to pay the tax on it. But you're able to give tax without tax consequence, this amount to 501c3 charitable causes that you so desire in this year. So I think that's a great opportunity. It's a great opportunity for you to make a bigger gift than what you could have given had you taken it as income and then made a gift. I think it might, because of this larger thing, it might be a situation where families, if you have a capital campaign or you have a special project that you want to support, you can give a one-time bigger gift if you so desire. You might give some for normal operating giving. You might have a portion of it that goes to a capital campaign or a special project of some sort. But you don't want it to come to you first, because then we're going to have to take out the tax. You want it to go straight to the charitable cause. And you notice here, you can take some as income and give some through a qualified charitable distribution. So here's an example of a both-and approach. Let's pretend again that your requirement is $18,182. You can do a charitable gift straight to your church, a qualified charitable distribution. Let's call it $6,000. That's the same amount we wanted to give before in that earlier scenario. And of what remains, which would be $12,182, we can take that as income. Again, this portion we'll have to pay our tax on, maybe 22%. And so then in the end, we would have $9,500 to be able to use to support life and ministry. And you'll notice if you do this, you actually have $1,300 more to live on because you didn't have to deduct the tax on this portion. I think in a lot of cases, this is the route that I would encourage you. I would suspect many of us need money for supporting our living. And that's why we put money into the IRA in the beginning. But we can use that when it's 70.5 to fulfill all of our charitable giving.
But Dustin, before we leave these two slides,
a
lot of times I think we hear the term "give your RMD." That's like we see it in marketing. So just to clarify that, that's a marketing thing, but that's not actually the way it's done, right? Just want to hammer that point home that when we say give RMD, that's kind of a misnomer in some ways, right?
Yeah. It's not like an either or. It's not like you either take your RMD amount or you give your RMD amount. I mean, that's an incorrect understanding. RMD is simply the amount of money that has to come out of your account. You then have the option to discern how best to bring that out of your account. And you're not limited on the RMD. So my RMD may be $18,182, but I need for my living and for my giving, I need $30,000. Okay, that might be the scenario. So I want to give $15,000 to my church and I want to take $15,000 to support my living. Okay, I actually gave more than my RMD, but RMD is simply the threshold of amount that has to come out of your account to avoid the penalty. Where it goes is a separate conversation. I think it's sometimes a helpful marketing if people didn't know that they could give what is in this case $18,182. They could give $18,182. They'd pay no tax. None of it would come to them as living. So, I mean, that's an option. So it's really about separating what is an RMD from supporting my living or giving a charitable gift to a qualifying charity.
Absolutely. So that's really important to know the difference there, right? And I think you've done a really nice job of clarifying. You don't have to give 100% of your RMD. You can, if you want, and pay zero tax on that distribution, but you don't have to. And then that prior slide really hammers home the point that if for some reason your Social Security, pension, other things equate to all the living expenses that you need, but your church or maybe another charity has a large project and you really have done a nice job of saving in your IRA, but you may never need it, you can actually give a larger gift there, knowing that you have sources of income that are covering living, but that RMD or the IRA rather can really be a source of making a larger contribution, even beyond what your RMD calculation would be.
Yeah. And that's, quite frankly, that's what I intend for my charitable wishes. My hope is that for the most part, my IRA will function as my charitable giving bucket. Now, the only way that works is I've got money that's in a pension, a defined benefit, and I'm putting money into a Roth IRA, which is an account that I will be able to take out tax-free. I pay the tax on the front side. So you're right. You very well could be in a situation where your traditional IRA, I mean, my encouragement for everyone is to let their traditional IRA be their charitable tool. It may also support living, but become first and foremost your charitable tool and help you think about how you can grow your giving to support your church and to make a difference.
Justin, we do have a question in the chat and I want to bring it up. I don't know. I don't have an answer on this directly. You may have. Do you know how penalties are calculated? So if somebody was not to take their RMD on time, what that penalty would be? I don't remember what that percentage is, but you may have it. And if not, we can look it up.
I would talk to your custodian just to confirm, but I believe it used to be much higher. I believe it used to be 50%. There was a penalty. I think the percent has gone down to 10% of a penalty. So I think it is not as bad as that used to be. Okay, but I think that there is still a penalty, and that's outside my ability to speak today. But the desire is to know your threshold and then to do your best to get above that so as to avoid the penalty. I know there's a lot of different circumstances, and that's just outside the scope.
Yeah, I think you're head on. I just happened to have a chance to Google that while you were talking, and you're right on. It was 50%. It may have ratcheted down to 25, and in certain situations, 10.
Yeah.
But it's still a pretty significant penalty. You don't want to lose that in terms of a penalty. The other question comes about DAFs, and this is one thing that's unfortunate about IRAs. When it comes to IRAs and making qualified charitable distributions, they have to go straight to a charity. They cannot go to a donor advised fund. That's a rule that's on there. You can give it to endowments. You can give it to like a legacy fund. You can give it straight to the charity. But unfortunately, you can't do a straight distribution, a qualified distribution to a DAF. And that's unfortunate, but that's one of the rules.
Yeah. So let me continue with a couple more of these things about this. We have a lot of folk who have a retirement plan account with their employer, a 401k, a 403b. There's other types that might be at play. In many of those situations, you cannot give a qualified charitable distribution from the account. So if you had a for-profit employer and you had a 401k and you've retired and you've come to 70 and a half years of age, you cannot give a qualified charitable distribution. Let's say you're 73. You would start having to take out a set amount. You would have a required minimum distribution from that 401k. The only way to do a qualified charitable distribution is to have a rollover. And so I can't speak for your exact situation, but in many situations, you have the option to roll that account from a 401k, 403b into a traditional IRA. Once it's in the traditional IRA, then you can do qualified charitable distributions for qualifying charities. United Methodist pastors, they have 403b plans with Westpath. The portion of that will be annuitized that cannot be moved, but there ought to be a portion that could be moved. Again, you're happy to visit with you about this, but you could move a portion of it in some circumstances to a traditional IRA and then be able to give qualified charitable distributions. That's my current intent. So if you're not yet 70 and a half years of age, what are other options? I mean, in my mind, I'm planning to do QCDs when I can, but until then, I use other tools to do tax-advantaged kind of giving, appreciated stock, using a donor-advised fund, other kinds of things. I'll talk about donor-advised things in a moment. The other thing that we want you to know about is that in most situations, the asset that will be have the enduring tax consequence the most are these IRA accounts. And those become the best tool to make sure in an estate gift that you direct your successor trustee or your executor to deploy these accounts, the traditional IRA accounts with pre-tax dollars, to deploy those first and foremost for a charitable gift. So we'll say more in a bit. So this is going to some limitations on QCDs, and let me address the second bullet first. This is what Tyler was just talking about. The IRS does not allow us to give out of our traditional IRA a qualified charitable distribution into a donor-advised fund. They want it to go to making a difference, not like put it into another tool that just pushes the distributions down the road a bit. So they've made a rule that you cannot do it into a donor-advised fund. I think it'd be advisable, I think it'd be something I would want them to change, but that's not how the current rule is. So you cannot give it into a donor-advised fund. As Tyler said, you can give it into any 501c3 charitable cause or into a permanent fund like with us, just not into a donor-advised fund. The other issue is you might have challenges. I've had a couple folk who've contacted me here at the foundation saying, I want to give a QCD to my church, but my church isn't populating on the list. They're using a larger structured organization. They're not using us in this scenario, and they're not seeing their church populate on the charitable causes that are possible. If that ever happens, you can contact us. We'd be happy to help facilitate that for you. We can't put it into a donor-advised fund, but we could help you get those dollars to the church. The rule is you can't give it to a supporting organization. And sometimes some entities have perceived incorrectly what the church is. So if there's a way that we can be helpful for you, please let us know. So let's talk about taxes. I know someone who registered asked a specific question about tax and how do we file our taxes and what does that look like? So let's walk through a couple pieces. The amount that you give to a qualifying charity through a qualified charitable deduction, QCD, will not be deducted on your taxes. So that is, you can't give it straight to the church and then also count it as a deduction and try to itemize on your taxes. You get either or. You can either avoid paying tax and give the QCD amount straight to the church and then file on your return a standard deduction. Okay, that's option one here, and that's what most scenarios probably serve us. Or you can take it as income and count it as a taxable income, and then those dollars you can give and then possibly itemize on your taxes. You just don't get to do both. You do one or the other. I think for many of our families, option one is the better option. I don't obviously know your situation, where you can avoid the tax on the QCD and then file your taxes with a standard deduction. But we need to know a little bit more to help you in your own specific situation. So here's an example. Let's say this person, this is a generous Methodist giver, okay, and they had a required minimum distribution of $18,000. It's not the $18,182 I had before, but it's close. So let's say it's $18,000. That's their the amount that they pull out, okay. If part of it goes to QCD and part of it comes for income, okay, the IRS will have, you'll fill out the IRS form 1099-R, the custodian will, and it's going to have the full amount no matter how it came out of your account, okay? So no matter if it was for income or for QCD, it's going to all be in one line. I'd like them to change that so it split it out and it made it easier, but that's not how it works currently. So it will be all here, and then down here, the distribution code, you'll have a number 7 as a distribution code. So you'll get this 1099 probably here in January, if this happened last year, and then you'll go to file your taxes. This is a sliver of the 1040 IRS form, and on row 4, IRA distributions it has, you'll put in A, the total amount, okay? So this is a scenario situation where a person pulled out somehow a total of $18,000. That's what's on the 1099. But you notice they had some of it. This scenario is illustrating that they took $12,000 for income and $6,000 went straight to the church for a charitable gift, okay? So what you do is you put the amount that's taxable over here. The difference is the qualified charitable distribution, and you need to write QCD on this line here to clarify why 18's there and not 18 over here. That's why there was a QCD amount that went straight to the charitable cause, so you only have a taxable account of 12 grand. And you need to have receipts that you receive from the charitable organization, noting that a gift from your IRA was given in a qualified charitable distribution. I know that one person who inquired about that was like, well, my 1099 says nothing about me giving a QCD. I actually helped a family member do this exact same situation, not these amounts, but the same kind of situation, and it doesn't show up. And so you have to do your diligence and have your paperwork in place, and this is how you would file it. If you have a tax advisor or a person that files your taxes, just make sure that the QCD gets in there and they understand some of the money went to a qualified charity from your account. One of the questions that was in our pre-work from a person was asking about different types of accounts and kind of strategies. And I don't have all the answers, and I don't know the details of each person, so it's probably having a lack of knowledge. But I kind of, in my brain, visualize our options in kind of 3 different types of accounts. We have these pre-tax accounts where the money is placed into the investment account without having tax, and the taxes happens when the money comes out, if it comes out for people, for my living or otherwise. We have the Roth accounts where the money is put in tax-free and grows tax-free, and then when it comes out, there is no tax consequence. And then we have the brokerage account where You already paid the tax on before the money goes in, but then you're taxed along the way as it gains interest, dividends, or realized capital gains. The one thing I want to point out is because of the Secure Act, this account becomes really important. These pre-tax dollars become really important to be the giving tool during life as well as in estate planning. Because someone will most likely have to pay the tax if it's taken for income. And so thinking about how to do that, the Secure Act changed things. It used to be that in many situations, maybe not all, but many, we would have the opportunity to stretch our distributions of an inherited IRA. And so based on your age, you could stretch that out over your life expectancy. But the Secure Act changed that such that an inherited IRA in most situations now has to be received over the course of 10 years. And those 10 years may not be the best time for a person to start receiving those gifts. Maybe you're 50 or your child who is to receive that is 50 or 55. Whether they want to or not, they're going to have to start taking income from that. And if they're not yet 70 and a half years of age, they cannot do a qualified charitable distribution. Maybe 50s, early 60s, maybe that's a good time for you to take the income and pay the tax on it. For some folk, that's when they're having a better working period in their lives, and so don't want additional dollars coming to them to support living. And so just having that awareness of that, there are some situations where the 10-year distribution rule is not in effect. If it's a spouse or if it's a minor of the person who dies, if the person is disabled or a chronic ill person, you can get different treatment. Or if it's a person who is not more than 10 years younger than the IRA owner, those rules don't apply. But in many of our situations, they do apply.
Justin, would you just go back to slide 17 right quick? Just had a question a couple of questions, I guess, in the chat here. Just to be real specific, and I think you said it right, but the Roth IRA, you use post-tax money. So you paid tax on that income, and then it goes to the Roth. You take it out. You don't pay income tax on the distribution, but it grows tax-free after you pay tax, like income tax money. So just wanted to clarify that. We just had a question in there.
What I was trying to say is you pay the tax prior to putting the money in. So if you think of seed versus harvest, you pay the tax on the seed, and then it goes into the account, and from there on, it will not be taxed. That's right. And you can take that out again when you turn 59 and a half years of age or older. You can pull the whole thing out if you want at one time. There's no tax. You can put this as a fund that goes to that next generation of family members, and they will not have to pay tax. They will have to receive the full amount over 10 years based on the Secure Act, but there will be no tax consequence for them. So once it gets in, then it's tax-free thereafter. Now, there's some other complications of pulling it out over a period of time. I'm not going to go into that, but just thinking of the tax-wise.
Also on this slide, I think it's the right slide to do this at. We have a lot of clergy folks on the webinar, and you're one of those. So just in terms of your thoughts, not advice, right? Not giving financial advice, but in terms of your thoughts, do you have thoughts on contributing to the clergy option for a pre-tax account? Do you have a thought whether you do that pre-tax or post-tax when it comes to your UMPIP?
Yeah. So here's just my thought and what I'm doing with my resources. So I'm trying to work back from what my end intent is. So that's where I'm starting with what I want to do, assuming I have a a full life of work and beyond. I want to give charitably at the end of my life. Okay. And I'm, between 10% to a third of my assets when I die. So that's my intent. So I'm trying to figure out, as well as to give on a regular basis when I become 70 and a half years of age and older, to support my church and other charitable causes. So I am putting money into this account to hopefully satisfy my charitable wishes. I would love it in a scenario where I don't pay the tax on the front side and I give it charitably on the back side, and it will have not been taxed in any place along the way. So I'm working with, in my mind, with that assumption. I'm putting money in here that will also support my living if I need it. But I put money into a Roth IRA. My current situation, I do the Roth IRA outside of my work with Westpath. So it's a separate one. So my work at Westpath is all 403B pre-tax kind of contributions. I have a Roth IRA outside of it. And so my hope is when I retire, I'll be able to pull money out of largely the Roth or maybe some brokerage accounts to support me until Social Security kicks in, and then be able to use this for charitable. At the end of my life, my intent is this bucket to be able to give charitably to support my estate giving. I know one of the persons who registered asked about, is it better to start giving more amounts at the beginning of RMD ages? So that is, you become 73. Should you start pulling more of it out early to kind of lower future RMDs? I know there's different advisors, and I don't know your situation. I think if you have limited charitable wishes, then that might be a consideration, especially trying to get money over into a Roth. I know lots of advisors encourage how to take pre-tax dollars in a way and get them into Roth IRAs. So you pay the tax when it goes from this bucket into this bucket because you want to grow tax-free. That's probably not what I'm going to do, because I want to give charitably of this bucket to fulfill that. So I don't want to have to pay the tax on the dollar. So I want to figure out how to have this be relatively robust to be able to give charitably, even if it's giving money that I was hoping would make it to my estate, giving it early so that it can start building those portions of my resources. Were there other questions, Tyler?
Those are the ones I've seen so far. This is certainly a good time to ask questions, as we're kind of near the end of the slide deck relative to this topic. So any questions that you'd like to ask of Dustin? You'd have permission to unmute if you'd like.
I just think this is a great tool for folk who want to give charitably, and you can do it in a one time each year. You find out what your amount is you have to pull out, and you make that distribution. I know some who have distributed it to multiple causes. You want to make sure that the charity is named. The family member that I've helped do this, we go on to the custodian and we enter the amount and the charitable cause. They actually send it to my family member, the check, but it's not addressed to, the check is not to my family member, it's to the charitable cause. But then my family member can get that to their church and other things that they want to support. It's a great means for us to avoid the tax on these dollars and to be able to give charitably.
Dustin, we do have a question. So related to UMPIP, which is the Westpath 403B plan. Now, 403Bs can certainly be used charitably. You just don't use a qualified charitable distribution mechanism on those. So just that's part of the question there. So you can use them charitably, but you don't use the QCD process like you would with a traditional IRA unless you roll it over. So just a little clarify that's kind of a technical thing. So, I mean, in concept, you do use your 403B as a QCD, but you have to roll it over into a traditional IRA.
Yeah. Yeah. A person cannot contact WestPath and say, I'd like to give a gift from my UMPIP or my MPP defined contribution plan and send it to my church. You're not allowed to do that. Okay. You would have to roll, and you can do an IRA rollover into a traditional IRA. Now, if there is money at the end of your life, you can designate charitable causes in the designation beneficiary form. We have multiple pastors who are doing that. And so they're giving whatever remains at Dustin's death charitably, and they can facilitate that. But while you're living, you're not able to give from those accounts. You'll have to roll it over the UMPIP or the defined contribution portions of the retirement plans. And I've done that with a family member, so I've been able to see how that works. And so that's my intent, is when I no longer am employed and putting money in, which I can't do it now, I have intent of creating a traditional IRA and moving those dollars out of that 403B that are movable. Some of it won't be movable, but the portion that is, roll that over and then be able to give qualifying charitable distributions.
And Dustin, do you want to clarify, like, or just maybe just broad stroke, how you would go about rolling that 403B into, who you would contact to start that process?
So I'll tell you what I did for my family member. So this person did have a WestPath account. So we created a new traditional IRA at a different provider. You know, it could be a provider that you trust, whatever account it might be. There's many of them that will provide that. We don't provide that. So Kansas Methodist Foundation could not do that for you, but you could at Charles Schwab, Vanguard, Fidelity, other entities. Okay, what we did is we created the new traditional IRA that was going to be funded by the rollover, and then we filled out the form with WestPath of rolling over the 403B account. And it went not to the person. So you don't want that. You don't want the money to come to me, Dustin, and then go. You want to go from the WestPath account to the traditional IRA account directly. Okay. And so they move the funds over, and then you can invest it as you discern is best and fits your needs, however that might be. But then once it's in that other type of form, you might have a fund advisor that has a Raymond James account or whatever it might be. They could facilitate that. If you have a brokerage account, they could probably add in a traditional IRA account, okay? And then they would be able to invest it in a way that you would so desire. You can self-manage those investments, but it has to be in that other status of account. And then you can do the qualified charitable distributions once you're 70 and a half.
So that person had another question here. So are there ways to be charitable with your MPP or your CRSP, that clergy retirement security program?
Not unless you move it into a traditional IRA. Okay. So you cannot contact WestPath and tell them to give a charitable gift from any of your accounts, zero accounts. You can put in there the designation beneficiary form. So if you die, it can go charitably, but not pre-death on those accounts. The only way to give a charitable gift from any account with WestPath is, and same would be for a 401k and some other provider, is to move it into a traditional IRA. And then you can do that, which, you might be thinking about what part do I need for income? Now, if you have the money that's been annuitized, okay, so that means the money is been put into a scenario with WestPath where they're going to send you a check every month until you die. And then if you have a spouse, there might be a remainder that will go to them. Those are all those rules you put in place when you retire. If it's been annuitized, you cannot. It would be the non-annuitized defined contribution part that is still not annuitized, and that part you could move over.
Very good. Not a question, but Brad from our Virginia United Methodist Foundation cares for an IRA I believe it's for his mother-in-law. But they have a program where they actually have a checking account attached to the IRA, and she can make her QCDs very easily with that checking account. So you might ask, at that proper time, you might ask your custodian if that's an opportunity, because that makes it a lot easier to request and make those distributions that way.
Yeah, and it's kind of nice to be able to be in that scenario because then you still, as a donor, a giver, have some, more agency, and you can have that tactile practice as opposed to going online and filling out a form and they send you the check. You can write it yourself, and make a debit on that account to satisfy that. So yes, those are there are some of those scenarios. And again, you can do more than your RMD when you do start having an RMD. And I want to clarify, I put here up to $105,000. That's not per IRA, that's per person. So we sometimes have families who have a couple different IRAs. That would be a possibility. It's not per account, it's per person. And so technically, if you're a married couple, and you file your tax jointly, for example, each of you could do $105,000. Now, you may not have the resources to do that. You may not have the desire to do that, but that's an option per year. I think we have one last slide, which is really about this remainder of your IRA. So if you think about of all the assets that you can give charitably, the best asset to give charitably is the remainder from your IRA account if you're wanting to give charitably. It's probably not the best one to give to family. There are other gifts that are better gifts to give to family. This is the best gift to give charitably, and which often prompts people to go, well, how do I put that all together? What's my plan? What are my next steps? And it just so happens that we have a plan and a program for that. Tyler.
Yeah, so we started doing this last year, rolled out our first cohort back in February of 23. And we call it Putting Your House in Order. It's a 3-part series. So people sign up, you work in cohorts for the information, and then we work individually, one-on-one, between sessions to talk through what we go through on each part of this program. So we talk about estate planning. So we'll go through in detail the difference between a will and a trust, the advantages of both, the drawbacks of whatever those are, and we'll talk to you about how to set one of those things up, and also about the supporting documents that are contained within that package. Your durable powers of attorney for health and finance, a living will, and then what a last will and testament in a trust might look like. So we talk through all those pieces, and we have a booklet that helps guide through that. Then we also talk about legacy giving. So just like Dustin's talking about, we can provide some information on if you want to make a gift through your estate, how do we do that in the most efficient and tax-wise manner? So we'll share some information about that. And then finally, we'll talk about kind of that memorial planning piece. How do you tie all this together? What do you need to leave behind for your benefits, your beneficiaries? And what do they need to know? That's kind of where your accounts are. Also some personal stuff, personal stories and those kind of things. So we wanted to make this pretty holistic. Everything's kind of combined together. Talk about estate, we talk about legacy, we talk about memorial, and when it comes to end of life things, these are important things to have settled well in advance. So we think that every adult needs to have a plan. It may not be as complex when you're 25 as it is when you're 55, but at the same time, everybody needs a plan. So we offer these. We'll start these on next week, actually, a week from Thursday, February 8th. We'll begin this session, and we offer 3 different time slots. You can do something in the morning, you can do something in the afternoon, you can do something in the evening. So we offer 3 different time slots on those 3 days. If you go through our program and complete everything and set up the legacy fund, we actually do have a program where we seed that fund, so you can start earning into your legacy account at that time. We encourage you to register, and some of you on the call today have already done this program. We certainly encourage you to share it with others and encourage them to utilize it. It's a free program. You'll get we think some good guidance, and we will also connect you with an attorney at the end of the process to actually draft your documents if that's needed. You may already have one, but we have a dozen or so contacts throughout the state that we can recommend to you as folks that are good at this work. So we'd love for you to be involved and encourage you to do so.
Yeah, it's kind of a program to learn some things and take action. I mean, it's not just learn and that was nice. It's learn and get things up to date or refreshed, whatever that might mean. One of the things I like about it is if you go through the program, we'll, as Tyler said, create this fund. We'll put a little money into it. And then you, if you will, have a vessel to put QCD gifts into if you want to give part of your resources to support ministry, however you determine that is. Your church or other charitable causes, other 501c3s that are within the church or beyond the church. I put a little bit of money in there in my account, my wife and I's account each year. And when we start receiving QCDs, that's my intent, is to start putting some money into there on an annual basis, and then the bulk when I die. So it's a great program. Tyler does a wonderful job leading that. For all these things, we try to cover broad things, but there's unique situations that are connected to you, and we'd be honored to help think through that. If we don't know the answers, we can partner with you to try to find some other information. But my hope and desire is that you and I grow in our relationship with God, and we find ourselves found faithful because of our stewardship, but because of our generosity, because of living out our lives as followers of Jesus Christ. And so I pray for you. Tyler, were there more questions or anything?
I think we're good on question end. I think I have one that I can respond to after the presentation's over. So in the interest of time, we'll let folks have the rest of their day back. But thank you, Dustin. We'll give you a digital round of applause. Okay. So the crowd is cheering. You can hear them from the rafters. So on behalf of the Methodist Foundation, thanks for joining us. We're really grateful for your time. We will send out a recording after a little bit of editing. We'll send that as well as a slide deck. If we can be of assistance, please let us know. We look forward to getting this information back to you, and we hope that you all have a very, very good day. Thank you.
Thank you. Blessings. Bye-bye.